Hello, ladies and gentlemen. Welcome to our webinar today. I'm Joseph Novichkov, Senior Trading Manager with the GDM. Today's session, ladies and gentlemen, we will have a look at the key fundamental factors when making commodity analysis. Basically, when we start with the overview approach of fundamental analysis on commodities, we will have a look at different varieties of commodities, such as food commodities, energy sector as well. Further down the line, when we go deeper into the analysis itself, we will also have a look at specifically for a few instruments that are mostly traded on, within our company or out there on the market as well. We will have a look at gold and oil in the energy sector. Basically, as we've made our research so far, the two commodities that are mostly traded by a variety of traders is gold into precious metals and, of course, oil, crude oil in particular, within the energy sector. First of all, a few reminders as due to our past webinars, as we've been talking about the key fundamental factors of fundamental analysis. And basically, this is a general idea of what exactly to look for. The last time we stepped a bit further into Forex fundamental analysis when we had a look at a few economic indicators that you should always pay attention to, and of course the financial markets reaction to news announcements. And the most important part of the whole session were the top 5 Forex fundamentals. We'll mention those one more time as they're extremely important, and for those that missed the last session, those are the first place takes interest rates, then we're moving down to employment, economic growth and trade, geopolitical events, of course, commodity prices, as we will talk about that today. The last place which takes the commodity price to the most important Forex fundamentals is due to the fact that a lot of currencies are closely connected to variety of commodities, such as gold production, let's say nickel production, speaking of which it closely connected to the Australian dollar. And when we talk about gasoline or oil price, then we're of course eyeing Canadian dollar and the US dollar. Today's session, the first thing we will start with is a general perspective in terms of fundamental analysis of commodities, as this is a means of analyzing commodities and trying to predict whether the price of commodities should be trading and what they will do in the future. So basically, what kind of direction the commodity at hand would have. The main BS of fundamental analysis is supply and demand. Supply and demand is a very simple equation, by the way, but it gets more complicated when you try to forecast prices in the future, especially when we are talking about commodity trades and their cycles. Sometimes supplies will be very tight and prices will be high. Other times we just have too much of certain commodity and prices will fall accordingly, of course. In the bigger picture, I like to have a look at commodities that are trading at a multi-year highs or multi-year lows. Eventually the picture will change, of course, and that will lead to a good trading opportunity. Of course, that's not only the case because there are people out there that don't really look at such big trends, and in particular swing traders or in particular scalpers, they don't even mind missing the fundamental analysis as an option into their trading. So price movements in commodities, usually traders are using fundamental analysis, and they can be broken down into very simple formulas. For example, if the demand is larger than the supply, that means we will have higher prices. If the supply, on the other hand, is larger than the demand, then of course we will have lower prices. It's that simple as it is. But if we take everything piece by piece and start first off with the supply of the commodities, we will find out that the amount that is carried over from previous years of production and the amount that is being produced during the current year is the actual supply. So, for example, the current supplies, let's have a look at food commodities. Let's take, for example, soybeans. Would include the amount of crops in the ground and the amount that is left over from the previous season, of course. This is season-to-season type of trading commodities. Typically, the more that is carried out from the previous season, the lower the price will be, and the more the price will be falling. There are many factors that can impact, of course, the supply of commodities, like, for example, weather, amount of acres that are planted, or depending on the measurement that you're using in your country. Here you can see pretty much on what we're going to move on. Right now we're having a look at supply of commodities. As we mentioned about the different factors that can affect the supply of commodities, first is the weather, especially if we're talking about the soybeans in particular, or food commodities that are largely affected from the weather. And of course, the amount of space that it's been planted, acres or any different type of measurement, land measurement. Production strikes, of course, crop diseases, and of course technology, which is used to carry out the work on the land, and of course that might increase or decrease production. The main thing to remember, ladies and gentlemen, when using fundamental analysis is that high prices of commodities will lead to an increase in a production, of course. It is more profitable to produce commodities when prices are higher. As of course everyone might expect, that it's quite logical. Demand will typically drop as prices move higher. Of course, the market in general is aiming to a sort of equilibrium. This is the so-called balance between supply and demand. That's why we see the shift in price, because the market is actually trying to stabilize itself. Sometimes, as we mentioned, in terms of food commodities, different factors can cause the supply or the demand to fall or increase. On another hand, the price will indefinitely react on that. That drives us to the next step here, where we will have a look at the demand of commodities. This is the amount that is consumed at a given price level. The rule of thumb is that demand will increase when the price of a certain commodity moves lower. It's quite logical that when demand increases, as the price of commodity will increase, of course, as well. This means that more of the commodities will be consumed at a lower price, which of course lowers the supply, and of course the price will eventually increase. Just think, for example, how much more liters of gasoline, for example, for $1.50, you would consume, rather than you would pay $3 per liter. For example, this is a very good example. You will consume much more gasoline if the price is lower, and you will consume less when the price is higher, because sometimes you might not even be able to afford such expensive gasoline. Fundamental analysis of commodities is simple. It's always about economics. Consumption patterns are, of course, changing as price of commodities moves higher or lower. So how in general are traders using the fundamental analysis to forecast future price movement? Prices, of course, ladies and gentlemen, will fluctuate in short term. So it is not easy to make fundamental forecasts for commodity prices and, of course, make short-term trades. It is even more difficult for new commodity traders to do the analysis itself. Therefore, it's much more suitable for intermediates to advanced traders, should I say. Not that you cannot try, of course, for learning purposes, but the first thing that comes to mind is that, especially when it comes to commodities, rather than the Forex trading, and as we mentioned the last time, there are many factors that has to be taken in hand when we're looking at commodity prices. It is, as we mentioned, very important to remember that, as a recommendation, new traders and even experienced traders use long-term strategy when using fundamental analysis to forecast commodity prices. You should, of course, have a look at trends that are developing that will cause, of course, a shift in supply and demand factors. So to begin your fundamental research of commodities, there are numerous reports that are compiled by different government sources. From USA, for example, if we are looking at the energy sector, for example, let's have a look at the energy sector. This should be the Department of Energy, and of course the futures exchange. It's extremely important. Many of the large commodity brokers or brokerage firms, such as ours, would allow themselves to release some kind of a research or a analysis on a day-to-day basis or week-to-week basis on a fundamental base to our traders, as well as we are doing at the moment. As just a slight deviation here, we're developing all of this, so in the future it will grow substantially. We will offer you not only short-term technical or fundamental analysis, we will offer you a long-term technical and fundamental analysis. We will be, of course, eyeing something into a quarter-to-quarter basis and annual basis. This will, of course, help you to keep a bigger eye on the picture that is ahead of us. So let's continue with that. So when we look for trends, long-term trends in production and consumption, and of course trade with that bias, we have to trade with the trend. Do not trade against it. From a technical standpoint, you already know that. So for example, if the supplies of a certain commodity are at a 5-year high, for example, and we have a record amount of production, for example, of this certain commodity, it is highly likely that the futures of this commodity will trade with a downward bias. Or what I mean by that is that the pressure of the price will be to the downside, because we have record production. We have a lot of this commodity. You will be, of course, very likely that you want to trade on the short-term side as well. It's well known that from a technical standpoint, prices fall much faster than they actually rise. Now, at some points, of course, the price of a certain commodity will get too low, and then the demand will increase eventually. Or there will be production problems. Sometimes this is a factor as well. And when I mention, when I mean production problems, let's take, for example, South Africa, one of the largest mining companies over there might be having some, let's say, a strike. So a lot of the workers will just go outside and protest because their wages are low or some other benefits that they would like to receive. Then we will have low production. Eventually, speculators on the market, as we all are, will decide to buy that commodity, and in particular, gold. So if, for example, we have a release of certain news that says we have a strike in, let's say, Rio Tinto or any other large drilling company such as this one, we will have eventually major rise in price from a short period of time. Those are also factors that might influence the price on a short term. The long-term trends, of course, in commodities are easier to spot with fundamental analysis. But of course, some traders might prefer to use technical analysis to capture short-term movements in commodity prices. This is also an opportunity, and this is what I would definitely suggest to all of the traders. It's much more difficult to make short-term fundamental analysis when you're evaluating various of categories on depending on the commodity and what is actually influencing it. In that connection, now we will have a look at the relation between gold and the US dollar. So aside from its role as a metal of or a commodity, gold is one of the oldest means of exchange known to the human race. In fact, gold has a dual role in both a commodity and a currency as well. So gold has, as we all know, amazing properties. As a metal, it's quite soft, dense, brilliant. So when we speak of, in terms of gold, in terms of precious metals in general, thousands of different civilizations in the history have covered gold. They've always been attracted to the metal. Even today, gold remains the ultimate prize, if you want to call it that way. Gold is not only a prize and a symbol of wealth, as some people, of course, might use to have this as a metaphor. Of course, a competitor who finishes in first place, let's say, on some competition or a race or any kind of a sports activity would receive a gold medal. Gold medal is a first prize. So the precious metal, the yellow metal, has some kind of a symbol, a prize, is also well known around the world, not only today but in ancient history as well. So let's have a look at further deep into this ultimate symbol. For instance, today it continues to be a physiological barometer of market sentiment. That's very important to know about gold. Gold is a rare metal. In the history of the world, mining has produced about 165,000 tons The fact that governments, ladies and gentlemen, around the world hold gold as foreign exchange reserve highlights the importance of that metal. Over history, many governments used gold to back their currencies, creating a gold standard. This is also something that most of you might already know. However, today, while governments maintain hoards of yellow metal, none uses it to back their paper money. The US dollar, for example, is the benchmark pricing mechanism for the yellow metal. Therefore, there is a special relationship between the price of gold and the value of the currency of the United States. Gold is an asset. As such, it has an instinct value. However, the value can fluctuate over time, sometimes in a volatile manner. As a rule, when the value of dollar increases relative to other currencies around the world, the price of gold tends to fall in US dollar terms. As we're looking at today's gold price, for example, it's been falling for the past 4 trading days. Majorly, only yesterday it slid about $13.50 down, reaching $11.85 as we've been tracking the price so far. Now, the relationship in gold versus the US dollar is because gold becomes more expensive in other currencies. As the price of any commodity moves higher, there tends to be less buyers, of course. In other words, demand goes down. Demand goes down. Controversially, as the value of the US dollar moves lower, gold will pick up its value because it has, it's people's appetite, traders or investors' appetite grows bigger and bigger because the metal is much more cheaper and they can afford to get more of it. Demand itself tends to increase at lower price. So sometimes when you see on the technical chart that we see some kind of a historical low levels, the price on the next day or in the next following weeks, even though, starts retracing slowly back up, or sometimes it picks up a high volatility and retraces with sometimes with about 20 to 30% in the next following weeks, because the demand grows as fast as the price falls. One way of looking at this particular gold-dollar relationship is that there are approximately, let's say, 320.5 million people in the United States, while total world consumption is about 2.7 billion. Less than 5% of the world lives in a nation where the US dollar is the national currency. The role of gold as currency is just extraordinary all around the world. While the US dollar gold price is a widely accepted benchmark, 95% of the world must translate the value of the metal to their own local exchange rates. All over the world, throughout the history and today, gold means money. So, having a brief look at gold, what it does when it's not interested on its own, it must, of course, compete with interest-bearing asset for the demand itself. When interest rates, for example, speaking in particular for US, so I don't need to mention that one more time as the relationship between USD and gold. When interest rates moves higher, the price of gold tends to fall as it's cost more to carry the metal. In other words, other assets will command more demand because of their interest rate component. Gold, of course, that means is a multi-faced asset. The price of gold is often sensitive also to the overall perceived value of the paper currency in general terms. During times of a fear, for example, or geopolitical turmoil, the price of the historic metal tends to rise as faith of government falls. That's also something that you might observe when you track a little bit back in the history and see where there was a political turmoil, for example, for a particular country which has, should we say, major effect on the global economy. And you will see that in this particular period, when this turmoil has been preceded, you will see that gold price will be rising during that time. But during times of calm and peace, gold price is usually falling down. As of course, the local currency is picking up, or the dollar itself, as a, should we say, something like a trust into the governments. Therefore, the local currency tends to have a bigger appetite in the hearts of investors and traders because it's a lower risk. That's why they're shifting their money into something which has lower risk. And as we know, the investor sentiment is one of the most important factors when we're speaking of trading at all. It doesn't matter if it's currencies, commodities, or anything out there. Government bonds, if you are trading, whatever. So, as perhaps the world's oldest and most storied currency, gold is an important barometer in the terms of global economic and political well-being. Therefore, the price of gold can go up on or down, of course, depending upon many factors. The fact that the US dollar is the benchmark for gold trading all over the world leads to special relationship that it has with the metal. On daily basis, of course, price movements in the US currency often influence the price of gold. This is what we had, as we mentioned, for the time of last week, and this week continues to fall down as well. Of course, we saw a slight consolidation after the recent peak around 12.30 an ounce. That makes it about $40 to $50 drop in about a week time in total, speaking of trading week. Before we move further down the line and talk a little bit more about the energy market, and especially I want to dedicate this particular section to the Energy Information Administration and, of course, the American Petroleum Institute. The abbreviations, you can see them on your screens. Those two reports carries out the largest weight, especially when we have, in terms of West Texas Intermediate benchmark or the US crude oil benchmark. We will not go deep into the Brent crude or the European benchmark, as in particular when we talk about the Brent crude, pretty much announcements from the Middle East and especially the Organization of Petroleum Exporting Countries it has the major effect on Brent prices. Not only, also affects West Texas Intermediate. But as we want to focus on week-to-week trading basis on from a fundamental perspective, those two reports carries out the major effect on short-term price movements on the energy sector, especially when we talk about oil and natural gas. So when we speak in terms of the energy sector, there is always a lot of interest in this market. Oil, for example, natural gas, coal, electricity, and any other energy commodities attract attention from producers, consumers, investors, and traders, speculators. These commodities and their price effect can actually carry weight to every inhabitant on this planet. Prices of all of those energy commodities can be extremely volatile, especially on announcements. While we are all, should we say, consumers of energy, no one in this planet is something else rather than that. The energy commodities are an important input for most businesses. In many cases, they are key cost of goods that are sold, or components, or anything into the production sector. As an example, one of the key inputs into production, for example, of aluminium is electricity. The cost, for example, of fertilizers and the production of those fertilizers includes the use of natural gas. So you can see everything is connected. All commodity prices are connected. One can affect another. So paying respect to all of little to large important events, announcements, or any piece of information out there should be considered as a good information. There is no bad information. In order to understand, ladies and gentlemen, the energy market and construct a view of the future direction of energy prices, analysts or anyone that wants to fundamentally assess the future of any commodity use both technical and fundamental analysis altogether. Technical analysis, of course, involves the study of patterns and price movements on charts, as we have taken a look at that many times from advanced perspective to all the intermediate and basic perspectives of the technical analysis. We have also combined so far technical charts with news trading and market pricing. This is what we've been talking about the last 2 months. It was extremely interesting, by the way, and thank you very much for all of your questions that I've received, especially about this topic. That's why it came quite important to me to lead only the fundamental part of the market analysis, basically because I understand how important for you is to have everything in one place, and you will have, should we say, a bowl of interesting topics and strategies that you might want to pick, those that are actually suiting best to your style of trading. Fundamental analysis, as we're at it, it involves complying and interpreting supply and demand data. This is fundamental analysis on commodities, only supply and demand. Nothing else carries so much weight on the market that actually can develop long-term trends. When it comes to energy markets, two sources provide some amazing insights into energy fundamentals. And those are Energy Information Administration and the American Petroleum Institute. The first thing, we will have the Energy Information Administration. According to the statements of the Energy Information Administration, it collects, analyzes, and dispatches independent and accurate energy information to promote price movement in commodities into the energy sector, whether that's going to be crude oil prices or natural gas prices. The Energy Information Administration compiles data and issues reports on petroleum and other hydrocarbon liquids, such as natural gas, electricity, coal, renewable and alternative fuel sources, nuclear energy, or uranium. So what you have inside your economic calendar, for example, you basically have the crude oil and natural gas. Everything else, by the way, you can get from their website, Energy Information Administration. You can get full reports, past reports, and of course some additional information on commodity prices. This is a very good general information for anyone that wants to make fundamental analysis independently to gather information from the web. The first thing that you need to notice is the accuracy and timing of this particular agency. Prices, of course, tend to move sometimes dramatically fast after the release of the report of the Energy Information Administration. For example, the agency usually releases domestic natural gas inventories on Thursday morning, somewhere around 10:30 a.m. Eastern Standard Time. Industry analysts will, of course, estimate this particular numbers prior to the release. And of course, if the numbers differ from analysts' consensus or their estimates, as we usually call it, the natural gas prices can react extremely with extreme volatility. So, but don't get me wrong, as we mentioned the last time for news announcements and reports and so on, this particular event and the volatility that it causes on the market is only short term. It will be often over not longer than the first 4 hours of the release itself. And then, of course, we'll have correction about 30 to 40%, sometimes up to 50% correction before the prices continue to the actual numbers release. So it doesn't matter if they miss expectations or they exceed the expectations by any chance. The previous and the actual numbers have the largest long-term impact on the market, and especially when we talk about week-to-week basis and to week-to-week data released by those agencies, the price tends to move in the direction where the actual numbers are pointing. So if they're lower than the previous, that means less natural gas is stored at a certain hub. That will definitely means that the price will go up for the next 1 week. And vice versa, if there are more inventories stored at a certain hub, then you can expect the prices to fall. It's the same saying about crude oil. And the reports of the Energy Information Administration, the releases of weekly reports on oil and oil products are pretty much a day earlier than the natural gas or at the same time. Sometimes it varies. It depends on, should I say, national holidays or any type of other criteria that they've decided to release the reports on Wednesday rather than Thursday. But most often those reports are released on Thursday, one after another. Usually natural gas is about, if I'm not mistaken, about an hour after the natural gas report. At 30 minutes to an hour, 30 minutes to an hour. So the Energy Information Administration is a government agency that is the so-called go-to source for fundamental energy data. The American Petroleum Institute, however, is something else. This is a national independent trade association that represents all aspects of the American petroleum and natural gas industries. The API, so-called API, has been around since the beginning of World War I, when the Congress of the U.S. oil and gas industries worked together for the war effort. The American Petroleum Institute also offers educational events, training and certification program for those involved in the energy industry. Of course, to touch base with those, you need to have quite hefty sum into your bank account. Not to mention that you might be have to relocate somewhere close to the NYMEX, so you can trade that. But as we're at it, the American Petroleum Institute, they also have a website, which is also an excellent source for fundamental data relating to the U.S. oil and natural gas markets. There also you can have a look at those that were actually, those traders that are actually focusing only on the energy sector trading. This is extremely useful information that you might get. They also publish their reports, of course, on their website. It's quite logical to determine that. The Institute also releases that data on a week-to-week basis. Of course, you can't really see that in the economic calendar, because we tend to believe that it's a non-governmental institution or independent private institution, which have no place into such calendars. But of course, you can use their particular website to determine whether you need more information, and if you do, it's a quite good source. I'm using this, by the way, both on the Energy Information Administration and the American Petroleum Institute. Simply the reports all around the different economic calendars, whether you are trading with us and you're using our economic calendar, or you're trading with someone else and you're using their own economic calendar, pretty much within minutes difference. All of this has is usually published. So when, ladies and gentlemen, investing in commodity markets, it is necessary, very important, to do your homework. And of course, not to mention on the last time, on the last place, a combination of fundamental and technical analysis will provide the best picture available for intelligent investment decision making. In fact, since energy affects almost every individual and industry, anyone that's making his investment decisions needs to understand and follow energy markets in order to be informed about everything. So both the Energy Information Administration and the American Petroleum Institute are tremendous resources for energy market fundamentals. Together, they provide a well-rounded view of current data as well as information for future concerns and initiatives, of course, in the energy markets. Now, the bottom line, ladies and gentlemen, the bottom line of demand and its application to fundamental analysis of commodities rests upon an understanding of consumer behavior. The factors which categorize consumer choice and how individual consumers respond to or reflect in the marketplace are key components of this economic theory of the fundamental analysis itself. Understanding what factors have affected demand in the past will help us to develop expectations about demand in the future and the impact on market price. I'm saying all that is very simple. Why? There's no one out there that will give you 100% guarantee that the price will go up, let's say, for gold or for oil. It's only natural to think that every natural resource will be depleted one day, and of course tend to believe that this price will pick up. That's logical. I will not argue with that, of course. But what you need to understand is by that time, those resources are depleted. It's quite possible that we might not be around, or there might not be a marketplace already. You never know. What we need to do is to assess history in order to evaluate future price movement in about 1 year or at most 5 to 10 years time, from a fundamental perspective, of course. For those that are only technical traders, I understand them personally. I'm also mostly technical traders, but I am, of course, paying attention to all the fundamentals as everything is supply and demand, and this is what I am showing to you here. This is I have not shown the equilibrium curve. It's not necessary because this is the balance as we spoke earlier, but this is pretty much the market demand curve, which demand for a particular product or service represents how much people are willing to purchase at various prices. Demand is a relationship between price and quantity. As you can see, price with the column and quantity on the flat line. Demand, as you can see, represented in front of you. Generally, that particular relationship between price and quantity is always negative. This means that the higher is the price level, the lower will be the quantity of demand. And of course, controversially, the lower the price, the higher will be the quantity demanded. It's logical, but of course, as I mentioned, the relationship between price and quantity is negative. That's what you need to remember. Market's demand will be affected by other variables, ladies and gentlemen, in addition to that particular price, such as various value-added services, including handling, packaging, location, quantity, quality control, and of course, financing. However, the demand for an agricultural commodity is typically derived from the demand for a finished product. It is important for you guys to understand that a free market economy is driven not by producers, but only by the consumers. That's why when you see consumer price index or consumer confidence for any particular country, let's say US, for example, because that's exactly the description that you see it in front of your economic calendars, or for any other country, it is the same thing. It means the same things, but it is slightly different. Ultimately, the market value for any goods or services is determined by its value to the consumer itself. Higher prices mean higher profits, and of course higher profits provide you with the incentive and the means to expand production of those goods and services, and of course consumers value the most. So profit-driven expansion is the market's response to stronger buyer demand. On the other hand, when consumers are unwilling to buy what is offered at the current price, the seller will have to lower the price, ultimately resulting in lower profits or losses to you or the producer. Losses that are reducing the producer's incentive to produce more goods that have weak demand, which will ultimately force production to cut at some sectors, as for example, farmers might be losing more and more money. This is the absolute discipline of the marketplace. As a summary, those who produce things that consumers are willing and able to buy are rewarded. Those who produce things that consumers won't or cannot buy are penalized. Farmers also must produce for the markets as well. That's all about the fundamental analysis on commodities. Those are the key factors that you need to pay attention to. And as we mentioned here in our bottom line section, price quantity relationship is negative. The higher the price, the lower the demand. The lower the price, the higher the demand. That's all for today, ladies and gentlemen. Thank you very much for joining us. I'm a little bit left without a voice after about 60 minutes of continuous talking, and I can see that there are a lot of questions flying in since the beginning. Most of them are actually connected to a few previous topics, which I believe it's going to take us about 20-30 minutes to cover. So believe me, I can see that you've left your contact details and, of course, your email address is here, so I can send you the replies as soon as the session is over. Expect the replies as soon as, let's say, within 30 minutes to half an hour. I'll try to answer each and all of those questions. And for those that are asking about one-on-one sessions, please, one more time, I kindly ask you to take the normal procedure. Just if you are not one of our clients or traders here, just contact the customer support department on our website. They will guide you through our registration form, and of course then you will receive the session that you're expecting. And for those that are already trading with us, they know what's the procedure. Just send me an email directly or to your personal account manager, and he will take care of you. Thank you very much for joining us. That's all for today. And of course, one more time, don't forget about the next webinar. That's this Friday. This is the final webinar for this month. The most important part, by the way, because here we will be measuring currency strength. And most of all, this is the culmination of the whole month of fundamental analysis. Thank you for joining us. See you next time. Bye-bye.